Hello, Freedom Nation. It's Jeff here once again, and we are on the Freedom Nation podcast. Today, I've got Patrick Grimes on with investonmainstreet.com. So he's going to talk to us a little bit about what he does and helps investors invest in distressed commercial property as well as distressed debt or debt instruments. So Patrick, welcome. How are you today, sir?
Jeff, really excited to be here. I'm doing great. On a little bit of a trip here over the summer in Honolulu, so a little earlier my time than yours, and looking forward to engaging in the conversation.
Yeah. You do realize it's October, so it's not summer anymore, dude.
The wife may have extended the trip incrementally here into fall.
Yeah, amazingly, we've stretched it a little bit farther. So, Well, cool. So why don't we get started, Patrick, by telling us a little bit about your story? How did you get to where you are today?
Well, so like many of your listeners, was a cubicle warrior. I was in a cubicle prison. I love what I do. What I did was a machine design, automation, and robotics. I have a bachelor's of mechanical engineering, a master's engineering, and an MBA. And I did automation for medical devices, solar cells, EV vehicles, defense, aerospace. Really cool, like one of a kind custom machines. And I was paid well. It was adventurous because I was constantly working on new gizmos and as a geek heaven, right? And but I got some advice early on to go. In fact, by the owner of the machine design firm, first one that I worked for, he said that his real regret was not investing more in real estate sooner, and that I should buy as much as I can as soon as I can. So I got real eager real fast after I got that advice, and quickly lost everything in 2008 and 9, being way too hasty, leveraging too much, all in development, risky assets, and everything flipped upside down. But worked my way out of that, followed the breadcrumbs of the wealthy because I was still a high-paid professional. I had somewhere I had to invest, and that led me back to real estate, kicking and screaming, but in a much more risk-averse, calculated way. And that's what led to kind of the growth of a single-family to large apartment portfolio.
Nice.
That is now 4,000 plus units and $500 million in real estate, as well as a large oil and gas portfolio. We've got over $20 million and in natural gas and oil wells. And we have this acquisitions fund and a debt fund, as we talked about too. So great ways to take advantage of the recession.
So let's kind of step back a little bit. How did you so you started single family. Were you just buying house by house at that point, or did you start pulling in investors to be able to buy a bigger portfolio, or how did you do it?
So after losing everything in pre-development, which was the very speculative side when I was in before 2008-9, I learned about cash flow, right? I learned about buying in recession resilient markets. And so I was in Southern California. I was in Southern California, where it's not landlord friendly, it's not tax advantaged, and it's just, you can't buy for cash flow. It's a horrible place. So I need to go. And so I did a bunch of analysis and research, a bit of an analyst myself, and I arrived at Texas and Houston specifically. And so I started buying existing assets with known comparables that they were trailing behind. And I could buy, renovate, and measurable improvement an existing cash flowing asset, and then cash flow. And then I could refi out my capital and then repeat. And it was essentially what they call the Burr method now. I didn't know that, I don't think that it was called that back then. It was just doing real estate deals. It was just buying.
Yeah, you were just renovating and flipping. Yeah.
I was just making it. I was holding, you know.
Oh, you're holding. Okay.
Yeah. But I was just making it work, and I was moonlighting it with my wife. And it was brutal. So, because you're high demanding, high paid, whether you're a doctor, attorney, whatever, an engineer traveling around, getting master's degrees, trying to make it work at your cash flow income job, trying to become your own expert in another industry, whether that be real estate or any other side gig, is demanding. They say it takes 8,000 hours to get mastery in something. If you've already done that, and what you're doing that again in something else, is brutal. And there's always somebody ahead of you, because there was always the next guy getting deals a little bit better than mine that had been in the industry for decades longer than me. So it was through that time when I was succeeding, but I was burning the candle at both ends. And I realized I needed to take a break and to marry my wife. And that was when I did my last single family closing And after that, I told her we're trading up, we're partnering now. We're learning to, I'm a partner with existing operators. We're going to trade into larger multifamily assets that we can buy in different markets, and I can partner with guys that will help acquire and manage as well as renovate these, and we can scale. And I can use my superpowers, which is deal finding and analyzing, and what ended up being capital raising too. It turns out I had a large network of high-tech professionals that have been investing with me, and
who are like you, that were looking to, okay,
yeah.
how do I do this? And you just kind of led the path for them.
And I guess it was just, they had only invested millions of dollars in automation equipment, and I said, well, let's do something that's a lot less risky, right? Let's do, and it worked out. So, yeah, we built the largest portfolio. Invest on Main Street is the brand, and we have lots of investors in real estate and oil and gas that have benefited. And passive investing mastery is what we have now, which is geared towards educating diversified portfolio of assets, all non-correlated to the stock market, don't rise and fall with the stock market, tax advantaged, income, cash flow. That's really our focus. And recession resilience, obviously, because that's the big key word for me, because I don't want to lose it again. And so I've been really cautious, the tortoise, not the hare, in building my portfolio to date. And we're uniquely positioned at this point to really take advantage of some of the really amazing buys right now that we're seeing.
So let's talk a little bit about that. You primarily are focused on the commercial market. What are you seeing? I mean, I know you hear it in the news, and I know on my other podcast, we talk about a lot of what's going on with the regional banks and some of the commercial properties. So talk a little bit about it from your perspective as an investor.
Yeah, so the last 3 to 5 years, say the last 10 years, very different, right, than what it is like today. It was before that we would buy properties and we could rely on steady state rent growth. And that meant that if we bought something that was a little under market, we could renovate it and then bump up those rents. And then that would attribute to a greater valuation, right? We could get great cash flow and valuation. Well, now with interest rates rising, it's harder to cash flow in these assets. Valuations are subsiding. 15, 20, in some markets 30% in commercial real estate. So there's a big reset happening. And so if you didn't go in, and the principles I talk about, which could be a whole different podcast on how to build recession resilience in your portfolio, but the principles are very low leverage, which means low loan to values, cash flowing, lots of capital reserves, replacement insurance, recession resilient markets, all these things, landlord friendly. If you built it all to last, then you'll ride this out, right? And that's what we're doing. But how to do a deal today? Well, it's very different. The deals 3 to 5 years ago are very different than today, and the deals in 3 to 5 years from now are going to be very different than today, I think. So what's happening today is I'm getting calls constantly for operators, owners of middle to large commercial assets that are struggling. Maybe they just got unlucky and they got a short-term bridge loan that's coming due right now, and they're all of their cash flow is eaten up by inflation and higher interest rate payments. The insurance has gone up, tax has gone up. Maybe they had a bunch of COVID delinquencies, which has been a major problem. People didn't restart paying rents after COVID. Rent assistance dried up, and then the courts got backed up, right? So there's just a ton of reasons why these amazing real estate deals, performing cash flowing properties, are financially under distress. It's not the property, it's the operators, right? It's a distressed operator, not the asset. And those are very different things.
It's not like it's a dilapidated building that you're buying. You're buying a nice building with a dilapidated owner at that point.
Yeah, they you know what? They didn't set themselves up with enough resilience in their operating business and the financial foundation of the property, or the insurance or the reserves or whatever it is, to be able to ride this out. And so we can be the source of relief. We can be the source of relief. And it happens like every day. Somebody hit me up. We can be a source of relief financially to a financial issue, not a distressed issue, but a financial issue, which is either through our PIM Rapid Lending, our originating company that does loans, commercial loans. We can be the source of gap or bridge lending, which can help them if their loan's coming due and they need a bridge to get past it, or maybe their interest rate cap needs to be re-upped, which used to be 100,000, now it's $1 million, and they didn't plan for that, right? And they need to, so maybe they need to restructure their debt, or maybe they just need a little more CapEx budget because inflation increased, and they're almost done. They're like 10%, 20% to go. So we can be the source of relief by providing gap or bridge lending through our income fund. And so if you investors in our income fund can enjoy incredibly high interest rates right now for great performing assets because interest rates are up. Sure. And the banks are pulling back their lending. It's still the same performing asset, cash flowing asset. Like we just originated a loan that was, or right now we're in the process of it cash flows at 10 cap rate, a 10% cap rate property. So it's cash flowing at all cash at 10%. It's performing asset. It's a 50% loan to value, and we're originating that at 13% with 2 points. So that's like 15% in the first year. Sure. I mean, that's an amazing interest rate for an investor to get immediate monthly cash flow at a first position at less than half of loan to value, very safe. And so the equity investors right now are getting squeezed because all of that value is coming out of their pocket, while the primary debt investors, the senior debt, the first position, are in a much safer spot because they're the last person to lose after all the equity loses, and they get the high interest rates today. So it's really interesting. So on the debt side, we have that. And on the equity side, if they're like, the operators are like, nah, I want out, or we don't believe in them, we don't believe that they're going to get out, we'll just say, look, we'll just buy it. Then we can come in all cash. We can come in all cash, we can buy it, we can backfill it with leverage if we want, but that allows us to reset the basis of this property at a price point where it will be a healthy project. Sure. Where we can cash.
Is that something? Yeah. Is it something that then you're gonna take control of that project, do whatever you need to, and then resell it, or what typically are you doing? Renting it out?
Yeah. So one of the asset we just picked up, we got it at $4.1 million in cash.
Okay. And
there was 2 other higher offers, but we closed after we completed due diligence, we closed in 14 days. So we just came all cash and bought it. And this is in the acquisition fund. Then we have the debt fund, the income fund, and the acquisition fund. So in this one, we chose to just buy the asset, right?
Got it.
So it's in the acquisition fund, investors get to enjoy a lot more upside. But yeah, so we bought it, and there was 2 higher offers. Right after we bought it, we appraised at $5 million. So right after the bat, we're at almost $1 million on a $4 million asset just from buying right. And that's the key, right? Yeah. Now, it happens to be that asset cash flows right off the bat. Very strong cash flow. Mm-hmm. But even it cash flows at 60% occupancy, which is what it's at. So there's 40% upside from just doing a lease up.
Sure.
And the owners were not sophisticated. They were just mom and pop living in California, managing Midwest property, and just didn't know what to do. We hunted it down off market, closed quick, got in. And the after lease up value was appraised at $8 million. So there isn't really a lot of lift to be done.
Yeah.
Just somebody who's not financially distressed, that has the ability to catch up, that's not behind on loan payments, that has better debt.
Yeah, you own it straight up, and you're able to cash flow that. For your investors, you're able to cash flow them while you get it improved upon.
Yeah, we have the capital, the know-how to market it right, to get it occupied, to get the right brokers in place, and to do that swiftly. And so the key behind recessionary acquisitions is buying right. It's not buying and then hoping on 3 to 5 year growth. In fact, I don't want to put my investors' capital in a 3 to 5 year deal if it's one asset, because they're going to miss this entire buying window. It's one of the most extraordinary buying windows of our lives. Mm-hmm. And so so if you go to the acquisitions fund, we're going to immediately buy things right. We're going to do a quick few month, maybe lease up with very light improvements, if any. Then we're going to refile part of our capital, like 50%, real low, buy a second asset, and then do an exchange of the first to a third. So the first asset just turned into 2 assets. And we're going to do that into 4 and that into 8. And so by swiftly trading forward and keeping the velocity of your capital high, you buy as many times as you can, stair-stepping yourself up as you go during this window for the next 3 to 5 years when there's just, we couldn't do this 3 to 5 years ago. The deals were just not this good on the buy.
You couldn't even do it 2 years ago. It's really been in the last year and a half to 2 years that this has started. And I think there's a lot more worse to come because I don't think interest rates are going down anytime soon. If you listen to the
Yep.
Fed's basically saying it's going to be high for longer than you think at this point, and we may even see higher. So I would assume for your investors, it's a good thing because they're getting typically higher rates. They don't have that. They don't have the downside of bonds where rates go up and their bond prices go down at that point. So
Absolutely.
it's kind of
Mhm.
the bonus plan on top of that. So you run two funds. One's the acquisition, one's the debt. Those are for accredited investors, correct?
Yeah, so when I started out, even on my very first deal, I've only ever offered 100,000 minimums accredited investors, and
Okay.
I didn't do the friends and family route. Like I had already lost everything once. I went to very sophisticated investors that knew the risks, and that's how I started. I've always been that way. Now, if you have listeners which are not accredited investors, I'm happy to chat with you, accredited and not accredited. Either way, I'm passionate about getting people on the path because I was once not accredited. And it took some people that invested time in me to kind of guide me along the way to get there. But if you're not, then set up a call. And the people that do deals for non-accredited investors, they're not on the podcast talking about them because they're not allowed to solicit. That's the whole catch 22, right? So it takes somebody like me. But yeah, so 100,000 minimums and accredited investors. And if you're interested, I mean, the debt fund, you can invest as little as 90 days. So that 100 grand you got sitting in the bank, collecting less than 1%, losing with inflation, there's no reason that shouldn't go into a rolling 90-day liquidity option. We can get you 7%, 188 and a half on 10 and 11 on 1 to 3 years. So, and then if you go 3 years with the equity side, we can go above 12.5%. So, I mean, it's immediate monthly cash flow with upside. And as I was telling you, the way that the loans are today, there's a lot of exciting debt products you can get that give you returns almost like some of the equity deals of yesteryear. But
Yeah.
in this,
Without the volatility of it, though.
about the volatility, you're in the first position on the property. I mean, I just got done saying that commercial real estate's 10, 15, 20, 30%, maybe in some markets. But we're lending in like 50% loan to value. I mean, so it's much harder for a asset-backed real estate debt fund to lose in a high interest rate environment like this.
Yeah, it's fantastic. So for the audience, accredited investor, you make at least 200 grand a year or $1 million in investable assets at that point, minus your house. So I think everybody should work to that in their lives, quite frankly. I mean, because there are so many more opportunities in the accredited space. For those of you that are out there that are already to one of those 2 points, these are the opportunities that are out there. And we've been trained, unfortunately, by my industry, we've been trained to say, oh, well, anything over 10% when the stock market is too risky or there's tons of risk. And quite frankly, there's a lot of things make way better than the stock market and have way less risk.
Yep.
The difference is liquidity in most cases. There's not as much liquidity in a lot of these things, although your debt fund really does have great liquidity and still fantastic rates on those short-term rates.
I'm constantly in phone calls with investors and they're saying, what other deal should I invest in? Right. Cause I'm in your acquisitions fund. And and they're like, well, I've got like 100 to a million, 2 million. You guys got $5 million sitting in a bank account or a brokerage account. Right.
Yeah.
And right now, if you're in Citibank, Chase, Wells Fargo, Bank of America, you're at less than like 0.01% interest rate. You're losing 5%. I mean, not actual inflation, over 5% a year. And if you're just socking that away, maybe I'll buy a rental in 3 months, or maybe I'll invest in the market or something in 3 months. Well, a 90-day note that you can choose to roll forward is a great response for that. It's exactly.
Well, and you've got people that have been sitting on cash for years, just sitting there. I've got a new client that I brought on board. And I mean, perfect example, between his individual accounts and his business, he was sitting on like $2.5 million.
Yeah.
And I mean, sometimes you have to make that simple step. And it was like, okay, why don't we just move some money and put it into a money market? You're going to go from making point nothing to 5.25%. Okay, that's a start. Now let's look at ways that we can improve on it. But it's scary to see how many people. I mean, it's great that they have cash, but that feel good doesn't always feel so good when you start to realize when you put real numbers to it.
Mm-hmm.
And we did the basic numbers for him, and it was like, dude, that's like a vacation and a lot
Yeah.
every year that you're just giving up because you're leaving the money in a bank account.
If he's got that, he's probably losing my entire like mortgage in Hawaii
Yeah.
every year, right? It's that brutal.
Yeah.
Yeah. So aside from just cash in the bank and the fear of inflation and potentially regional bank collapsing, because if you have over 250,000 or whatever, 300,000, then you're leveraging in a destabilized banking system. You're putting at risk that those funds, and asset-backed real estate, especially in the senior position, is a much safer bet.
Yeah.
In these, but the aside from that conversation, there's trillions of dollars sitting in IRA and 401k accounts, and I've got tons of investors that they're under the impression that their employee-sponsored IRAs or 401ks are locked up and hidden away, and that's not the case. I write for Forbes. I've got a ton of articles. I just published a new one, How to Invest for the Upside of Downturns, Patrick Grimes Forbes, and I've got some out there specifically on how to allocate a piece of your retirement funds, IRA and 401k, into self-directed variants, which allow you to invest in alternative to help balance where America has the majority of their wealth in their single-family home and in their retirement funds. Help balance that out of the stock market right now, that wild roller coaster, and putting some of that into acquisitions funds like mine, where you can win from the downturn, helps to hedge against the decline of the rest of a portfolio, or into a debt fund where retirement accounts were built for debt funds because they just consistently push out cash flow. You don't have any tax issues with debt funds. So the income fund is just magical. And we even have, if you really go down the IRA rabbit hole, there's even something called UBIT, where when you invest into real assets, sometimes the government can be like, hey, maybe you owe us some fees or taxes essentially on part of what you're earning. But we're sophisticated to the point where both in our acquisitions and debt fund, we have UBIT blockers, which allow you to avoid having to pay UBIT, file the UBIT returns, and we can just pass through what would be a higher return as if you would have just invested directly. So
that's fantastic.
We're really built for people that looking to diversify their cash positions, like you said, as well as their retirement accounts, because these are the vehicles that really get you there faster.
But I mean, I look at it too. It's not just people that are sitting on cash. It's people that are sitting with bonds in their portfolio right now. We're in a bond bear market massively. The 20-year debt fund, TLT, is down, I think, 23% over the last 2 years. And that's what people are relying on to be their safe portion of their portfolio. We've had portions of this year where stocks have dropped. I mean, August stocks dropped and bonds dropped at the same time. So having these other types of diversification, utilizing real estate debt and everything else in a portfolio it's an alternative to bonds, especially in this rising rate environment.
Agreed, 100%. The challenge with everybody right now is just that fear. And I really hate the quote Warren Buffett said, when others are fearful, it's your time to be greedy, because I'm an analyst. I don't think you should ever be greedy or fearful. I think you should just be calculated. But when others are fearful, that is an interesting time to dig into the numbers.
Yeah.
And right now is if you can look past the fear mongering on the news, and you can look past that sense of just hoarding away, like I feel safe because I have cash in a volatile bank account or something in a retirement account managed by somebody else in Wall Street, right? If you can look past that, and you can actually look at the numbers, this is actually one of the most unique and advantageous times to invest in real estate, both on the debt and equity side, for decades. And so the typical accredited investors I'm having conversations with, and they're kind of overcoming fear. But the institutional investors are just dumping cash into these acquisitions and our debt funds. In fact, typically we would have like 140 to 230 average investment for a deal. But it's because we've had such large checks from high net worth individuals coming in, 4 million plus checks, that it's gone up above $1 million on average. Now, we do have a lot of $100,000 investors, but but right now, the bigger players are moving. They're deploying capital for this very limited window that you can do so for these higher returns.
Yeah, it makes complete sense. And then you're in the position where, okay, you're earning higher rates as other things are going down. You're continuing to earn higher rates for a while on a lot of this too.
Exactly. Yep.
Well, fantastic. Is there anything new in your world that you guys are working on or?
Yeah, so between the acquisitions fund and the debt fund, we're just having a really great time. There's a lot of exciting things. I'd recommend reach out. If wherever anybody's at, I'd happy to get them pointed in the right direction.
Okay, fantastic. Well, let's jump into the fast 5 questions now. Ready?
Fire away.
All right. So you wake up in the morning. Question number 1. You wake up in the morning, business is gone. You have $500 in your pocket, laptop, computer, place to live. What are you going to do first?
Yeah, so I suppose these are questions I should have prepared for. So you're going to get like the off the cuff. So I don't have any savings. I only have $500. Everything is gone.
Yep.
Yeah. Do I have my wife and my puppy and my baby boy?
You have your whole family, everything else, place to live, food, all that good stuff. What are you going to do first day?
What am I going to do first day? Well, I'm going to go look for where that immediate income is to support the family, right? Okay. Yeah, that's what I'm going to do first day. So I don't know how else to say that.
Right, you got to pay the bills. Yeah, you got to pay the bill.
Yeah, you got to pay. And then obviously you're going to look for that next. I'm an entrepreneur at heart. I'm a serial entrepreneur. I'm a very calculated guy. So I'd be looking for, just like I am now, what's the way to lean into whatever it is that caused that issue, just like now we've turned our business around completely and we're focused on leaning into the downturn now. So recessionary acquisitions and recessionary income fund. So whatever that is that drew us down, figuring out a way to win from the upside of that downturn of whatever it is that drove us to that position is what I would do. Now, for me, if I got $500 in my pocket, because I was a high-paid engineering tech professional, I could always just go back and do that, save up money, and then start flipping single-family homes and get back into the game again pretty quick. So that'd be probably my way back up.
Nice. Well, you kind of did this anyhow with 2008.
Yeah, exactly.
Second question, what's the biggest business mistake you've ever made?
So the biggest mistake I've ever made was when I dove into what got way over my head, highly leveraged, all in on one deal, fully recourse in pre-development, my very first deal. And wow. I did not pay it. I was very excited about really high returns. And I did not pause. Maybe I justified it, didn't have time to. So I was kind of relying on just like the track record of a single developer, but I didn't zoom out far enough to look at, here's the market cycles, right? And will this survive a cycle? And I zoomed out just far enough to look at the last like 4 deals and saw how well they had done. And so my biggest mistake was investing for shorter term gains and not looking at the longer term vision.
Sure. Got it. Yeah. And that'll be the one that comes back and bites you. You're trying to make your millions off the first deal. And it's like, okay, that's not going to, it's the people that are more consistent over time. They're the ones that make the money.
Yep.
What's a good book that you'd recommend for our audience?
So one of the family offices that invests with me is a dear friend. His name's Trey Taylor. He wrote A CEO Does These 3 Things. And tell you what, love that book. In fact, I run every morning and I listen to podcasts, TED Talks, and audiobooks. And I'm always engaging in personal improvement on those runs. And I'll listen at 1.5 times. But I actually slowed it down to 1.25 and then I slowed it down to 1. And when I talked to Trey, I said, that's the best compliment I can give you. Because it is, if you're real passionate about your organization and you're a CEO and entrepreneur and you want to learn how to foster and grow that and foster the right kind of community within your company, CEO Does These 3 Things. You should read it at least 3 times.
I love it. Absolutely. And listen to it at single speed.
It's singles, yeah.
I'm the same way as you. I blasted out 1.5 times on most books, and there's been a few that I have to come back and say, okay, let's do it at 1 because I really need to absorb this information or it's worthwhile. So awesome. What is a tool that you use in your business that you might recommend?
So right now, I just did we do with PassiveInvestingMastery.com, we do these educational webinars, and we'll do panels with We just did one on laundromats, self-storage, car washes, multifamily, oil and gas, where we just kind of duked it out and talked about these alt assets. I just did one on AI, just me, and all I did was talk about practical tools to advance your business, practical AI tools to advance your business. And I'm constantly using ChatGPT, Google Bard, and a slew of other AI tools because it is just extraordinary the amount of ways that it has made us more efficient as an organization. And this, sure. I did a whole presentation just on that and I got a lot of really good feedback.
Have you gotten onto the Monica train yet?
No, I haven't.
That is the coolest thing since sliced bread. So Monica, I think it's monica.com or something like that. You can go on there, and what that one does is it aggregates ChatGPT, Microsoft Bard, or Google Bard, and I think 2 or 3 others. So it's one of these things where it's like it conglomerates all your answers into one.
I use the AI API tools to do that. And so I can actually select how long I want the answers to be, the temperature, the level of creativity, and I can throttle back the expense that I want to, and I can select which AI tools and which versions of what AI tools. Pretty impressive. Yeah. So I'm doing some things. I'll take a look at Monica, but there's a lot of really cool stuff out there along those lines.
Well, I'm seeing, I think I just saw Zoom this morning added an AI tool into it. So I used to have my annoying AI tool that would pop into these things. Well, now it just automatically is in the Zoom tool. So I think AI is the world of the future, and I don't think people need to worry that we're going to be in the Terminator or something like that. So
agreed.
I think it's a productivity enhancer for most of us. Okay, last question. What is your definition of freedom?
Well, so the ability for us to live where we would like to live, I think, and to be able to choose what we get to do when we wake up. Like when we were during COVID, my wife came out one day and was like, "Hey, let's move to Hawaii." So I had us on a plane 2.5 weeks later. And so it was just that ability to just pick up and move. And my wife, she does feature-length animated film producing, but she doesn't have to. She does it because she loves it. And I like that.
And she can do it from anywhere in the world, wherever you decide to be. So
Right.
That's fantastic. So Patrick, if somebody wants to learn more about what you guys do, learn about some of your educational resources, where's the best place to go?
So I go to passiveinvestingmastery.com, and you can see information about our acquisitions fund, our income fund, which is the asset-backed debt. You can also register for our educational series on alternative investments. And we're trying to do there, and you can set a meeting up with me. I'd be happy to talk to anybody. And if you do set up a meeting with me, we ship out a copy of my Amazon bestseller for free. It's got a lot of great content. I did a chapter along with Phil Collin, the lead guitarist of Def Leppard, and NFL, NBA players. It's persistence, pivots, and game changers, turning challenges and opportunities. Such a fun book to write, and it inspires a lot of people. So I just ship out free copies and I sign them. But yes, jump over there. At the very least, jump into our educational series. Start getting more aware of places you can invest outside of the stock market. You'll hear from all kinds of people doing all kinds of stuff. We have recordings from some of the past ones. And we have multifamily stuff on our Invest on Main Street. It's our sister company website as well. So you'll see a lot of stuff and articles I've written on Forbes and ways you can begin to kind of chip away at increasing the financial awareness and the financial IQ and alternatives to that wild ride of that stock market.
Mm-hmm. Yeah, and the wild ride where you don't have any driving control in that.
Exactly.
Well, Patrick, thank you so much for being on today. It was really a pleasure, and love where you're doing. Once again, another alternative for our audience that qualifies for this, but I think just learning about some of these other passive income alternatives and using alternatives in your portfolio. So thanks a lot for being on. I appreciate you, and appreciate you being up early for this today.
Thanks so much, Jeff.
All right. Well, folks, as always, we do these twice a week on Tuesdays and Thursdays. So make sure that you take the opportunity to subscribe to the channel so that you're getting these. And if you have a chance, where you're watching this or listening to it, give us a 5-star, give us an up arrow, give us a a thumbs up, whatever you can do to let us know that you're out there and share. So thanks a lot, and we'll see you guys back here the very next time.